This week we are conducting two interesting webinars. The first webinar is Mid-Year Financial Checkup. Are you still on track? Here in this webinar, you will be knowing whether your portfolio is aligned with your financial goal or not. And the second webinar is Financial Freedom, Aspiration, Action, Achievement. Here in this webinar, you will know what actually financial freedom mean to you. To join the webinar, click the link.
Making passive, boring investing in large companies work is something that doesn't excite people. Why should you do that? What's in it for me? It's anyway not possible to beat a benchmark itself. Why can't I simply go and invest in the benchmark Nifty? Where is the need for me to create a portfolio in large cap which is unique? These are all questions that are commonly asked by most people. But as an investor, I believe that the market is always going to misprice even large companies. Companies within the Nifty tend to get constantly mispriced. If, as an investor, you can follow a reasonable active approach to build an aggressive portfolio of large caps, it is possible to beat the benchmark and do much better than that. But if I made this claim, people would have clearly launched themselves at me. Where is the proof? So I thought, let me conduct a public experiment and let us try to arrive at the proof. Either I learn that I am wrong or I prove that it is possible. That is what led to the boring stocks index. For the last 42 months, we have been running this portfolio. Every month, we make disclosures of the performance. Once in a year, we make changes in the portfolio. This is an equal weighted portfolio of 10 stocks. Interestingly, it has performed better than any other product in its category since inception. This portfolio benchmarks itself with the Nifty 50 TRI. If you had invested 1 lakh rupees in the Nifty 50 TRI on January 1, 2023, it would be worth 1,37,298 rupees, translating into a 37.3% simple return over 42 months. During the same period, if you invested the money in the boring stocks index, which I am curating and maintaining, that 1 lakh would have become 1,79,842 rupees, translating into 79.84% simple returns. So the benchmark got beaten by 42.54% over a period of 42 months. And what did we do? First, we created an equal weight index. Then 1 year we made some changes. The second year we didn't make any changes. The third year we made some more changes. The changes were made at the beginning of the year and not any time during the middle of the year. So through the year, the portfolio has been passive. A very simple approach, a very disciplined way of owning an investment, and a very transparent way of being accountable in measurement. This is Boring Stocks Index in a nutshell. The journey of the Boring Stocks Index in 2026 as well as that of Nifty 50 TRI has been underwhelming from January 1. If you invested 1 lakh rupees in the Nifty 50 TRI on January 1, 2026, it's worth 91,836 rupees as on today, translating into 8.16% of negative returns. The same money if invested in the Boring Stocks Index on January 1 becomes 92,360 rupees, translating to minus 7.64%. So we have done better than the Nifty 50 TRI. We beat it by 0.5, but we are in the red this year. The companies that have done badly in this calendar year are many. In fact, when I look at this portfolio, it's easier to identify the companies which have done well, just a handful. The Positive performance has come from Coal India, which is plus 11% from Jan 1. It has come from ICICI Bank, which is plus 2.8%. Larsen & Toubro is up barely by 1%, and Sun Pharmaceuticals is up 8.9%. The rest of the companies are all in the red. So 6 of the 10 companies are in the red, and in fact, they have got battered. HDFC Bank is down 19.5% from January 1. Reliance Industries is down 17.5%. Bharti is down 12.2%. Maruti is down 15.5%. Mahindra and Mahindra is down 18.4%. It was just brought in on January 1. And ITC is down 16.9%. So you have 6 of these companies all down in double digit, several in high double digit. So when a majority of companies are down and by a wide margin, and a small number of companies are up and only 2 are up by even a half decent margin, you are having a very tough year. The coming months will see whether these companies which have been badly bruised this year by FII selling make a comeback, whether they are able to bounce back at least to the levels they were at the beginning of the year. If these companies go back to the level at the beginning of the year itself, that would make a significant impact to the performance of the Nifty as well. But more importantly, if that happens, then the performance of the boring stocks index would continue to beat the Nifty by a decent margin, because most of these companies are very material to the index and have very high free float. So this is what remains to be seen and proven during the rest of the year. This is what we will be watching out for as the markets consolidate, gain confidence, and show more strength in the coming months in the Nifty. Let's see where the Nifty 50 TRI moves next month, and let's see how the boring stocks index keeps pace with it, or with some luck beats it. Watch this space. Thank you for watching this video.